Aterian stock has been trending in popularity in the recent past, and even now, a lot of people are wondering if they should be buying more, selling what they currently have, or stand on the side and wait for better entry timings. As the market is very volatile at the moment, we should be mindful about which positions to pick, as well as their exposures and timing. Over the past few days, the price actions of Aterian has brought the stock to a peak or relative peak of $6.55 before stabilizing around the current $3.14. Aterian has been on a relatively stable, grinding sell-off recently until the month of April when the stock has seen a significant uptick from $2.43 all the way to above $6. I think that overall, the stock should expect to continue its path upward because if it can survive the recent market sell-offs, then it can also go beyond. I'm not referring to how it's going to make new highs in the short term, but how the stock has been able to maintain itself above $3 overall. And this in by itself is a significant feat in those challenging times the market is facing. In the long term, the stock would either have to prove that its fundamentals have changed or that the short sellers have massively redeemed their positions for the trade to really work. So far, it has worked at a decent level for many investors simply because the price is sufficiently low, the supports seem to hold its ground, and there remains a large amount of short sellers who are paying financial fees for their positions on a daily basis. Now, let's also take a look at the technicals of the stock. The trading volume of Aterian has recently been 11.3 million shares versus the average volume of 27 million shares. Over the previous 52-week period, the price fluctuated between $2.10 and $21.07. The market cap of Aterian is currently at $183 million versus the enterprise value of $121 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on the current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the value may be impaired. With that being said, at the end of the day, this remains an estimation of the market every time it publishes financial statements. So it's relatively less reactive than the market cap and often more lenient as well. One key element to note about the enterprise value is that for many growth type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it may have a better management, a stronger brand recognition, or a bigger online following. It's what makes it unique in comparison to the alternatives. In other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, as the market cap is lower than the enterprise value, which is more arbitrary, and also because the enterprise value is less reactive to the market conditions. If the company goes to liquidation, the goodwill would be gone, and we would be left scratching the bottom of the pan of whatever that's not evaporated yet. When we compare the current price to the historical price fluctuations, the stock is 26% higher than the 1-month low, 51% higher than the 12-week low, and 51% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 180% versus the historical volatility of 210%. The put-call volume ratio is currently at 0.11. It's normal for many stocks to have a higher put option volume than what they deserve, as many institutional investors hedge their positions by buying put options. The most recent volume of options traded is 16,000 contracts a day, versus the 30-day average of 78,000. As for the open interest, the most recent volume of open interest is 303,000 contracts, versus the 30-day average of 320,000 contracts. In terms of its shareholder structure, institutional shareholders own about 21% of the outstanding shares. The biggest shareholders include Vanguard, State Street, and BlackRock. It's relevant to understand the shareholder composition of a company because this helps to determine if you should hold the stock long term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short term trade. Obviously, it's subject to a lot of exceptions, as there are many great companies mostly held by retail investors as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this is a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 43% of the total floats, and 38% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out of the dark pools, this is a sign that institutional positions have been taking place to short the stock, and there would be potential for a short squeeze. Overall, my opinion about Aterian is to have a position in the stock as a short-term trade, and if you believe in the company's own fundamentals, then I would recommend to keep around 20% of your position in for the long term. I would recommend to commit between 1 to 3% of your portfolio. I would also recommend to split the allocation in batches of 10 to 20% at a time so that you may purchase more in case of further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, When it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.